get the best out of your investments and become rich fast? Do you want to avoid investment mistakes and be a successful investor? Hello and welcome. I am Prarthana from Clear, India's largest tax and financial services platform, where we have assisted 6 million plus tax filers so far. Do subscribe to our channel to support us and to get to know more about the best investments to reach to your financial goals. Investment planning involves identifying your financial goals and creating a plan to invest and achieve them. It ensures you earn higher returns from your investments. Begin investment planning by saving your money. Identify your financial goals and the time to get there. You must analyze your risk-taking ability. Learn about the various investment options and choose investments that match your risk appetite. Spread your investments across different assets classes such as equity, fixed income investments, golds, etc., called portfolio diversification. Finally, choose investments with the potential to give inflation-beating returns and study the lock-in period and after-tax on investments. The rule of 72 shows you the number of years it takes to double your money at a specified rate of return. It is a simple formula, 72 by interest rate. For example, suppose you choose an investment with an annual fixed interest rate of 8%, it would take 9 years to double your money. The 100 age rule helps you decide the proportion of debt and equity in your portfolio. It says the proportion of equity in your portfolio should be equal the difference between 100 and your age. For instance, if you are 30 years old, you must allocate 70% of your portfolio towards equity. 100 minus your age, that is 30, that is 70%. The 10-5-3 rule helps determine the average rate of return from your investments. You can expect a 10% return from long-term equity investments, 5% return from debt investments and 3% return from savings banks account. Remember that you cannot get guaranteed returns from mutual funds and the rule only estimates mutual fund returns. The table is showing the importance of investment planning. The biggest investment mistake you can make is not investing at all. You will never reach your financial goals in time and you will lose the benefit of the power of compounding. One of the common mistakes you can make is investing without an investment objective. For instance, you will not commit to an investment if you don't set financial goals such as buying a house, money for retirement or finances for your children's higher education. The second common mistake is investing without understanding the investment. If you invest without studying the features, lock-in period and risk to reward ratio of investment, you will end up picking something that does not match your risk profile. You will lose money if you cannot exit the investment in time because of a lock-in period. Another common mistake is allowing emotions to rule your investment decisions. It is especially true for equity investments where fear, greed and other emotions result in heavy losses if you enter or exit the investment at the wrong time.
Speaking of investment mistakes, invest in equity investments for a short span. Otherwise, the consequence will be that the stock markets are highly volatile over the short term, resulting in losses. Secondly, trying to time the stock markets by buying low and selling high, wherein investors run the risk of missing periods of exceptional returns. Thirdly, not diversifying the portfolio sufficiently, wherein it increases the risk of losses if some investments underperform. Fourthly, chasing hot stock tips from friends, family and social media, wherein investors fall prey to pump and dump schemes. Second, lastly, investing in stocks without knowing the company's business, wherein it is like driving blind and chances of losses are very high. The last investment mistakes that you must avoid to commit is investing money you will soon need for daily expenses, wherein investors lose money as they exit investments during a financial crunch.
Many people invest in mutual funds and stocks which have done well in the past. Is it a good idea? Well, many mutual funds have a disclaimer. The past performance of the mutual fund is not necessarily indicative of the future performance of the schemes. It is a warning you must take seriously and avoid chasing returns in mutual funds. Picking past performers blindly results in investing without paying heed to your risk tolerance and investment horizon, thereby increasing the chances of losses. I hope by now you have understood the common investment mistakes made by investors. Comment clear if you are clear or drop your questions if any. Don't you want to know the common investing mistakes to avoid this financial year? Many people make the common mistake of altogether avoiding equity investments. You must avoid this mistake in the financial year 2022-23 as equity investments can give you inflation-beating returns and help you reach your financial goals sooner. Avoid investing a lump sum amount in equity funds this financial year and try the systematic investment plan or SIP. You can purchase more units when markets are down and fewer units when the stock markets rise. Another common mistake you must avoid this financial year is stopping SIP when stock markets crash. This table is showing common investing mistakes to avoid this financial year. The 15-15-15 mutual fund rule helps you make your first 1 crore from the stock market. According to this rule, if you invest Rs 15,000 through monthly SIP in a mutual fund for 15 years, you can accumulate a Rs 1 crore corpus assuming a compound annual growth rate of 15%. Use ClearTax SIP calculator to determine the corpus. However, you cannot reach a corpus of Rs 1 crore in 15 years if you stop your SIPs when the stock market crashes or goes up. To conclude, one of the common mistakes you must avoid in this FY 2022-23 is investing without considering inflation. Stay in control of your emotions and get a financial education before commencing your investments this financial year. Thank you so much for watching this video. If you have any queries related to investments and taxes, please do comment them below. We will address them as soon as possible. Stay tuned for more updates and don't forget to subscribe to our channel for finance related content. Take care, thank you so much and goodbye.